My investing strategy has seen drastic changes in the last year. Today, I'll explain what's different and why I'm more confident than ever. But first, here's what went wrong and what I've learned from my £18,000 loss. Let me be honest, it wasn't just one mistake, rather a combination. But one of these mistakes multiplied it from just a small error and into a 5-figure loss. In fact, it was the easiest mistake to avoid, and it happened twice. A few of my stocks had a streak of poor earnings updates, which caused the shares to fall in price over time. I thought investors were being irrational because I saw the dreamy long-term picture. So I decided to buy more shares as the price fell, thinking it's a bargain. In reality, I was in a tunnel vision, trying to apply a plaster to an open wound. I focused too much on the share price, which blinded me to the rapidly falling intrinsic value. And I've learned that dollar cost averaging isn't always a solution to a falling share price, and that an investor should always keep an open mind on whether it's an appropriate time to buy or sell. Which brings me on to how my investing strategy has evolved. I used to daydream about how much money I would make if a stock reached a certain price per share. Could you imagine Boohoo at £10 a share? And I've discovered that it's really easy to trick yourself into buying a bad stock if you believed it could give you really high returns in the future. Instead, I now focus on purchasing stocks with quality business models and predictable earnings. In my 5 years of investing, I've learned this, and I've learned that there's a lot of things that I don't know, and being able to identify cheap or undervalued stocks might not be as easy as it seems. But it's hard to mistake a consistently growing free cash flow over a 10-year period or a stable returns on capital employed. In fact, I don't care for the share price or market cap at all. The share price isn't important on its own. Of course, it's a requirement for other calculations, but the share price without context is meaningless. And this is why I'm confident on the future of my portfolio. I have peace of mind, not bogged down worrying about the movement of share prices. I can sleep well knowing I'm invested in durable businesses with competitive advantages in industries with high barriers to entry. Ashtead Group is a great example. They lease equipment. It doesn't sound like much, but think about it. They are a market leader in the West, in an industry that requires serious money to operate in. They have a huge cash flow, meaning they can stay up to date with the latest equipment or lend at a cheaper rate than the smaller competitors. That said, it is easy to be overconfident, so what might I be doing wrong right now? Well, I have a system that ranks a stock's KPIs to assess its quality, and I've checked my whole portfolio, which you can view live to see all of my holdings, their average share prices and current returns, just by clicking the link in the description down below. But there is one slight problem. I'm overexposed to one stock. This stock is also the smallest company in my portfolio by earnings. Despite having the highest quality score, its smaller scale and dependence on retail behavior might mean that I'm taking on unnecessary risk. On the other hand, it's also trading at an attractive price to its historical average and has a free cash flow yield of 5.8%. Here's the problem. Games Workshop takes up 46% of my portfolio. Is it too greedy? Well, click here to learn about my greed being exposed.